Today, we're diving into the mind of one of the greatest investors of all time, Warren Buffett, to uncover a strategy that seems almost counterintuitive. How to invest when the stock market seems overpriced. In a world where market highs often lead to investor frenzy, Buffett's approach offers a beacon of wisdom. Prepare to challenge your perceptions and learn the art of smart investing, even when the market seems at its peak. Understanding market valuation, the Buffett way. In the intricate tapestry of the stock market, understanding valuation is akin to finding a lighthouse in a stormy sea. Warren Buffett, the legendary investor, navigates this complex world with a unique philosophy that becomes particularly crucial when stocks seem overpriced. His approach, deeply rooted in value investing, offers a masterclass in discerning true value in a market that often seems to defy logic. To grasp the essence of Buffett's strategy, let's rewind to the late 1990s during the dot-com bubble. As internet companies with little to no profit soared to dizzying valuations, the market was caught in a frenetic upswing. Buffett, however, remained undeterred by the euphoria. Instead of plunging into the tech frenzy, he maintained his focus on companies with strong fundamentals and clear, understandable business models. This period is highlighted by Buffett's decision to invest in companies like Coca-Cola and Gillette. While the tech world bubbled, Buffett was pouring funds into these traditional companies known for their long-standing market presence and consistent performance. His rationale: these companies had tangible assets, reliable earnings, and a sustainable business model, aspects that many overvalued tech companies lacked. This decision was not received well by many at the time, with critics claiming Buffett was out of touch with the new market realities. However, the burst of the dot-com bubble vindicated his approach, as many high-flying tech stocks plummeted, while Buffett's investments remained stable and profitable. Buffett's approach during these times reflects a deeper understanding of market valuation. It's not about the current hype, but the intrinsic value of a company. He assesses businesses based on their long-term prospects, management quality, and financial health, not just their current market price. This method involves looking at metrics like earnings, dividends, and growth potential, and comparing them to the stock price to determine if a company is undervalued or overpriced. The key takeaway from Buffett's strategy is the importance of discipline and sticking to one's investment principles, even when the market seems to be moving in a different direction. It's about having the foresight to see beyond temporary market trends and focusing on the fundamental value. Buffett's approach during overpriced markets teaches us that successful investing is not about chasing the next big thing, but about thorough analysis, patience, and a clear understanding of what you are investing in. It's a reminder that even in a market that seems irrationally exuberant, there are opportunities for those willing to look deeper and think longer term. In essence, Buffett's way is less about timing the market and more about assessing the value within it, a strategy that has stood the test of time in his journey to becoming one of the most successful investors in history. If you are enjoying the video, hit the subscribe button and comment if you know any other story about Buffett. If you want to explore money-making strategies, click the link in the description to start your financial journey. The power of patience and diversification. In the intricate dance of stock market, where frenzied highs often lead to panic-driven lows, Warren Buffett stands out not just for his astute investment choices, but for his unwavering patience and commitment to diversification. This approach forms the crux of his investment philosophy, particularly vital when navigating overpriced markets. Buffett's strategy is akin to a seasoned gardener who knows the value of both patience, and diversity. He understands that a well-tended garden cannot flourish with just a single type of plant. Similarly, a healthy investment portfolio requires a mix of different assets. This diversification is Buffett's hedge against market volatility. When one sector dips, another might rise, maintaining balance in his overall portfolio. One of the most telling examples of this strategy in action is Buffett's handling of his investments during the 2008 financial crisis. While many investors panicked and sold off their stocks, Buffett remained composed. He not only held onto his diversified portfolio, but also seized the opportunity to invest in companies like Goldman Sachs and General Electric at bargain prices. His patience during these tumultuous times was not a passive waiting game, but a strategic choice based on a deep understanding of market cycles. Buffett's approach to diversification is not limited to different types of stocks. He also invests across various asset classes. For instance, he holds significant positions in real estate and bonds. This spread across different investment vehicles is a testament to his belief in not putting all eggs in one basket, a principle that reduces risk and increases the potential for steady returns. Moreover, Buffett's patience is legendary. He famously said, "Our favorite holding period is forever." This is not to say that he never sells, he does, but his decisions to sell are based on careful analysis rather than market pressure or short-term fluctuations. This patience is crucial in overpriced markets, where the temptation to follow the herd can lead to hasty decisions and significant losses. Buffett's success in diverse market conditions serves as a powerful case study for investors. He highlights the importance of having a well-rounded portfolio and the wisdom of patience, instead of reacting to market highs and lows with knee-jerk reactions. A diversified approach, combined with a long-term view, can lead to more stable and successful investment outcomes. In essence, Buffett's power of patience and diversification is a dual strategy that plays a pivotal role in wealth creation. It underscores the truth that successful investing is not just about making the right choices, but also about having the patience to stick with those choices through market ups and downs, and ensuring these choices are varied enough to withstand market uncertainties. Investing in oneself and non-stock assets. In the final chapter of understanding Warren Buffett's investment strategy, especially in overpriced markets, we delve into a less conventional but equally pivotal aspect: investing in oneself and non-stock assets. This approach is about broadening the investment horizon beyond the stock market to include personal growth and alternative assets. Buffett himself is a paragon of investing in self-development. He has often attributed a significant part of his success to continuous learning. Notably, Buffett invested in the Carnegie public speaking course early in his career, which he credits for building his confidence in communication, a skill that proved invaluable in his business dealings. His commitment to self-improvement highlights a crucial investment principle: the most valuable asset you can invest in is yourself. Enhancing your skill, knowledge, and personal development can yield dividends in all aspects of life, including your financial endeavors. But Buffett's wisdom doesn't stop at self-investment. He also advocates for diversifying into non-stock assets, especially in times when the stock market is overpriced. This strategy acts as a buffer against stock market volatility. A classic example of this is real estate investment. Unlike stocks, real estate is tangible, often provides steady income through rent, and can be a hedge against inflation. Buffett himself, through Berkshire Hathaway, has made significant forays into real estate investments. Another avenue is investing in bonds or treasury bills. While these might not offer the high returns of stocks, they provide a safety net in volatile markets. Buffett's foray into treasury bills during uncertain market periods is a testament to the role in a well-balanced investment portfolio. Then there's the realm of alternative investments, from art and antiques to commodities like gold. While these might not be the core of Buffett's strategy, they represent a diversification that many investors seek, especially in overpriced markets. For instance, during times of economic uncertainty, gold often becomes a popular investment choice due to its perceived stability. Buffett's approach to investing in overpriced markets teaches us that successful investing is not just about where you put your money, but also about how you invest in yourself and diversify your investment portfolio. It's about recognizing that wealth isn't just accumulated through stocks, but through a combination of personal growth, diverse asset allocation, and a strategic approach to investment. In essence, this approach is a holistic view of wealth creation. It transcends traditional stock investing to include personal development and alternative assets, providing a more comprehensive strategy for financial growth and security. It's a lesson in not just being an investor in the market, but an investor in oneself and a diverse range of assets, ensuring a well-rounded and resilient approach to building wealth. With these insights from Buffett, you are now equipped to make smarter investment choices, even in challenging market conditions. Here's to investing wisely, no matter the market's price tag. If you like this type of content, then press the like button and subscribe to our channel.